All right, guys, we need to talk about something really, really important. And I'm telling you, this is probably the number one mistake I see investors on our buyers list make. And this is the number one thing that you need to do starting today. So, a lot of you are in here for different reasons, whether you want to have rentals or flips or rent to owns or whatever your exit strategy is. We'll talk a little bit about that in a future video. But if you don't have these different buckets of money set up, or at least if you don't start the wheels in motion on some of these buckets of money, it's really, really going to lag you down. And I've had buyers come on the list and they get one of the buckets of money and they just don't start the process with the other buckets of money. And what happens is they have sort of this, especially if they're a newer investor, sort of this, well, I just need to get one deal right now. And then what happens is they get one deal and they realize, well, it's really not that hard. And they want to get a second deal. And a great deal comes up on their plate shortly after they acquire that first deal. And they don't have another source of funds set up ready to go to purchase that. And they miss that. And some of these opportunities, I mean, you're talking 5 to 6 figures of potential profit on these. You do not want to be missing out on these just because you don't have your buckets of money set up properly. So let's get into it a little bit. The first thing we're going to talk about is a pre-approval. This is really what we need to get set up with all these different lenders. And so basically what a pre-approval is we're just asking for like the green light from a lender. Now, some of these may be different. Like in our process, we ask you to make sure that you're pre-approved through lenders. So we're either going to need just to see like a basic letter from the lender saying, hey, this person's pre-approved for X amount of dollars. Or let's just say like we're pretty casual if you're emailing back and forth. Let's say with one of our hard money lenders and they say, yeah, you're good to go. You can just forward us that email as well. But you need to have that blessing up front from them before the deal hits your window. Because if the deal hits your plate and you want to buy it and you don't have this pre-approval set up yet, no good. You're never going to get a good deal, especially from us. So you need to have that green light ready to go from a lender first. So this is why this is the first video we're showing you here, because this is the first step. Before we even start thinking about getting a deal, we got to start getting some green lights from some lenders. What I also want you to think about is think of it like a job interview. If you're just casual with it, like, oh, like I hear this a lot of times, oh, that lender never got back to me. Well, think about this. If you really wanted a job and that particular employer didn't return your first call or your first email or something like that, what would you do? Or what should you do? You should continue to follow up with them, right? And continue to show them that you're serious and build a relationship with these folks, because these people are literally going to unlock tons and tons of options and opportunities for you if you do this correctly over time. So just treat it like a job interview. The other thing about these pre-approvals, each lender is going to have different requirements to get pre-approved, and we're going to get into some of that here in the next couple slides. But just understand that going into it, that even if they won't pre-approve you today, or if you're thinking in your head right now that you don't have the sources or the options or the credit or the whatever the case might be that you think they need, that's okay. Each lender may have different requirements, and so it's important to get the ball rolling with all 5 buckets of these money, okay? And then think about what's your unique advantage that's going to ensure that the lender's loan is safe with you. So all of these buckets of money, other than your own cash, really, the lender really wants to know if they're going to give you money, what's their insurance or their reassurance that they're going to get that money back. That's the most important thing to them. So what do you bring to the table? You know, I know some folks that we'll get into some of the buckets here, but you know, they might not have a lot of cash themselves, or they might not have great credit, but they do have experience working on properties. You know, maybe that's a contractor. That's a great unique advantage, and they can highlight how successful they've been maybe on some of these. They could put a little packet or a portfolio together to show, hey, these are some of the remodels that I've done for other customers. This is what I plan to do on the ones that I'm going to be buying, showing their credibility. So that's just one example, but what is your unique advantage? What do you bring to the table? Maybe you have a great W-2 job and you make really good money. You just have no experience. Well, highlight the things that you do have, okay? All right, let's get into some of the buckets. The first bucket of money that you need to have is a hard money lender. Some folks maybe refer to this as like a loan shark or a money broker, but essentially what they're doing is they're taking other people's money and they're borrowing that just like a bank at a lower interest rate, and then they're turning around and they're upcharging that money to you, and they're doing all the underwriting of the deal and that sort of stuff to make sure that they're the people whose money they're using, that money is safe and that they're going to be protected, okay? Now, there's some pros and cons to this. So typically these are the highest rates and fees. For example, our local hard money lenders typically charge 12% annualized interest So think of that like 1% a month, $100,000. You're going to be paying about $1,000 a month, and they usually charge the highest fee. So they'll charge 3 points. So a point, if you're not familiar with that term, is basically 1% of the loan. So if it's 3 points, that's 3% of the loan. So again, if we're going to use $100,000, you're talking $3,000. Now, our hard money lenders will typically roll that into the loan. So that means that you don't have to come to closing with a $3,000 check. They'll typically put that in the loan. Now you're gonna get charged 12% annualized interest on that 3%, but you don't have to come to the table with any funds. So that's a unique advantage of that. Okay, this is usually the quickest way to get funds for a deal if you're pre-approved. So we've had situations where these hard money lenders can close it like in a week or less. So if, let's say, a great deal comes across your plate, you can say, hey, I got cash to close, right? I can close this thing up quickly. If you know you got this pre-approval behind you, you can say that because you have the ability to get those funds really, really quickly. Some are going to lend on the purchase and the rehab. So what's really nice, like our local hard money lenders, they will lend on the purchase and the rehab, which is unique. So that means you don't have to fund the rehab as long as you get the property and the numbers to work out. So in our examples, let's say it's $100,000, the hard money lenders that are in our local market here, they will lend you up to 65% of that after repair value. So if the appraised value, or the ARV as it's called, is $100,000, they will lend you $65,000. So let's say the purchase price, you're going to get it for $50,000. That means you could have up to another $15,000 to fix this property up. So essentially having no money out of pocket if it worked out that way. All right. With hard money lenders, a lot of them, relationship is important. So they want to know you, like you, trust you. Again, we go back to that job interview thing. If they don't think you're competent enough to do this deal and that you're going to be able to keep this money safe, they're probably not going to lend you. And it's really at their discretion. It's a commercial loan or a business loan, so they don't really have to follow a lot of the underwriting guidelines and some of the other guidelines that are out there if you're getting like a traditional mortgage. All right. It's good to have at least one of these that you're pre-approved through. And I say that because I hear this a lot of times. People are like, oh, I don't want to pay 12% in 3 points or whatever that hard money lender is going to charge. There's other ones out there on a national scale that charge less, but maybe aren't as easy to work with and that sort of thing. So there's pros and cons to each one. But I recommend you just get set up with them. Even if, hopefully you never have to use them if you have other sources, other buckets of money. But there's going to be situations I've used them and I never thought I would. And it worked out great. I had to pay them back, and they took a pretty big chunk, but it was better than passing up a great deal. So these guys are great options to have. We've also had some private lenders who've fallen through at the last minute. The person was not set up with a hard money lender, and therefore they lost out on the deal, and they had to pay a pretty high earnest money deposit that they lost, and all that sort of stuff. So just be aware of that this is just good to just get it set up, even if you don't think you're ever going to use it. You may need an LLC, you may not. Again, some of the national lenders out there require that you have an LLC. Some don't care. Some of our local folks don't care if you have an LLC or if you do it in your personal name. But just be aware of that. That's just a talking point that you want to make sure you have with the hard money lender. Okay, conventional lender. Why do we need to have this set up? This is typically going to be the toughest underwriting guidelines, which basically just means it's going to be the hardest to get approved for. So you got to have good credit and usually a W-2 job and those sort of things. So if you don't have those things, you'll need to partner up, which we'll talk about that as a bucket of money going forward. But these are usually going to be the lowest rates and the best terms. So typically you can get 30-year fixed rate financing. So you're going to lock in that interest rate for 30 years. These typically have the longest lead time, so usually you're going to need to have at least 45 days from the time that you get the accepted offer and contact your mortgage broker. You'll want to be, again, pre-approved, ready to go, but they're typically going to take at least 45 days to be able to close this. Now, maybe even longer. Depends on the economics and the environment and that sort of stuff. You'll want to make sure you have that conversation with your mortgage broker. Typically, they're going to require 20% down on a single family or 25% down on 2 to 4 unit property. So have that conversation, because I know just today, and probably depends on your specific credit situation and those things, a mortgage broker had told one of our buyers that if he's looking to refinance, he is going to need 25% on a single family. So it depends on the economy and where things are at and where your things at. So have that conversation. That's typical, and you may need to shop that around to different conventional lenders if you are looking to have less into the deal. These conventional lenders are not going to lend above 4 units. All right. So if you're looking at 5 units or above, this is not going to be the lender for you. And these are a great arrow in your quiver for refinances after improvement. So we have a whole course that we'll talk about at the end of this that you can join up with if you are interested in learning more about how to refinance for rentals out of it. But again, even if you're here because you're flipping, I still recommend you have this, because let's say the economy takes a turn or for some reason you can't sell that property, you're going to need to turn that into a rental. And if you used hard money to purchase the property, you're paying some pretty high interest. You're going to want to refinance that hard money lender out of it and get into some cheaper long-term money, at least until you can sell that property, so you're not taking a bath on all that high interest. All right, so that's bucket number 2. We got hard money lender, conventional lender. Number 3 is a commercial lender. Some people call this a portfolio lender. Some people call it a community bank, a business banker, maybe another name. These would be like smaller community banks. So in our area, we have a bank called Nicolay National Bank. There's Bristol Morgan is one that we highly recommend, Range Bank, Fox Community Credit Union, Bank of Luxembourg. They're just typically not going to be like a Wells Fargo type of institutional, national, worldwide lender. They're going to be a smaller community bank. Typically, when they do a loan, they keep that loan in-house. So that's what portfolio means. They don't put that on the secondary market and use like Fannie Mae, Freddie Mac underwriting guidelines. They can be a little more creative, and they can typically offer the best structure to a loan if we need to get creative with that loan structure. Okay. Another misconception I hear a lot of time is that you need an LLC to get a loan through a business or a commercial lender. Just another thing to have that conversation, like we talked about with the hard money lender, you may not need to have an LLC. So don't let that hold you up from taking action. I hear that a lot as an excuse. Well, I can't, Corey, I can't make an offer on that property. I don't have an LLC yet. Doesn't matter in a lot of cases. So get the lending set up. They'll tell you if you need an LLC or not. If you do, get it, but don't let that be a hindrance to getting out there and taking massive action. Okay? Similar to hard money lenders, these lenders are going to be heavy on relationships, experience, and common sense. So if they look at it and they're not comfortable for some reason, maybe you haven't done a deal yet, depending on the economic environment, they may tell you, hey, go out and get a deal using hard money and come back once you've got a little bit of a track record and show you that you can do this, and then we'll look at lending to you. Just have those conversations, because even if they can't pre-approve you now, it's a great idea to start that relationship and ask for feedback on what you can do to get pre-approved in the future. And it's good to have multiple options for these commercial lenders. Some of them like real estate investing, some of them don't. Some are more into manufacturing or different types of businesses. Some like the value add projects. Like I love the BRRRR strategy and the value add stuff. Some people like more of the turnkey stuff. They'd rather loan to you or lend to you once that property's already fixed up and stabilized. So have those conversations. Good to have different options for these commercial lenders for different purposes depending on where your business goes. All right. Bucket number 4 is private lenders you need to have, and I highly recommend these as well. These are friends, family, coworkers, whatever the case may be. They're mostly relationship-based lenders. They typically know, like, and trust you. So, if you have a nice base of people and you're a pretty trustworthy individual, there's a good chance that there's some friends and family sitting out there that have some money sitting on the sidelines, or maybe have it in an investment that they really don't want to keep seeing fluctuate. They'd rather just get a steady return, and you can offer that to them as being maybe a partner in a deal. Maybe you give up some equity in the deal, and what I mean by that is maybe a piece of the profit, or maybe you just give them an interest rate and allow them to put a mortgage on the property. Whatever the case may be, whatever they want. This is how we actually got started. We took a private loan from a family member who had it in a mutual fund, and they didn't want the fluctuation of the ups and downs of the market. They just wanted a steady interest rate return, and so they lent it to us for about 6 months and made a nice steady return, and then they allowed us to keep using it over and over and over again. So it's great. Typically, if you do a good job of this, they'll like it and they'll want to keep that money in play, and they'll want to, pretty soon they'll start begging you for opportunities. So the first one might be the toughest to get at this, but plant a lot of seeds right now. Get some private funds set up and have this available, because potentially, let's say you're using hard money as your main option. They only go to 65% of the ARV. There's still some great deals out there above that, depending on the spread that we're looking at, there still may be some great opportunities there, or you may want to supplement and use the hard money lender for, say, half of it, and then you're going to use the private lender because they're cheaper for the other half of it and reduce the amount that you need to borrow from this hard money lender. So if I see people just have hard money lending, typically they're not going to be the most successful on getting deals from us. They're going to need some other source of funds to supplement the hard money lender so that they can go above that 65% overall budget if need be. All right. But they can be great for cover rehab, parts of the purchase, etc. Social media, just be careful. You can't offer an investment opportunity currently at the time I'm recording this due to SEC laws. I'm not an attorney, so talk to your attorney about all this stuff. But just let people know on your social media that you're in real estate now and start to build your brand consistently over time, and people will want to partner up with you. And just be careful about how you word that. Look into the laws on what you can and cannot say on social media. Okay? HELOCs or home equity lines of credit. This is bucket number 5. This is one of my favorite buckets. This is one that a lot of times people don't even realize they have access to. Or when I tell them private lenders, they start saying, well, I don't know anybody with money. And then we talk about the HELOC, and all of a sudden, bam, they start thinking about people that have money. So a HELOC, what does that mean? That's a home equity line of credit, not a home equity loan, a home equity line of credit. So think of it like a low interest credit card. And what I love about this is it's typically dead money. I call it just sitting in a property, either your property or a family or friend's property. So if they've had that property for any length of time and the market's appreciated, they've paid off debt, they have this spread in there. And a lot of banks out there love to do these home equity lines of credit. And in fact, a lot of times they'll even offer to do it with no closing costs. So they'll typically cover the closing costs and the appraisal fee. So it's basically like you're unlocking all of this money that you've used to pay down your house, or that just by the market appreciating has caused the spread. And depending again on the economic environment, they may go up to, say, like 90% of the value of your house. So let's just use an example here. Let's say your house is worth $200,000. It appraises out at $200,000. They would lend you up to about $180,000. So let's say you owe $100,000 on your mortgage. They may give you this line of credit for $80,000. All right, that's if they go to 90%. Some may only go to 80%, but you can shop that around as well and find out who can give you the most money in the home equity line of credit. And again, if you don't own a home, that's okay. This is a great thing to talk to with your private lenders and find out, do they have equity in their home? And let's say the bank's going to charge them 5% interest. Maybe you offer to pay them 12%. So now they're just playing the bank and they're making that extra 7% on money that was otherwise just dead, just stuck in their property, not doing anything for them. All right. So what if I can't get a pre-approved? All right, again, that's the whole goal of all this stuff. Get all of these buckets and the wheels in motion so that you can start getting pre-approved, because some of it takes time to do. Like, some of these guys, it's going to take 30 to 45 days before they will give you a pre-approval, because you have to go through their underwriting and due diligence and all those sorts of things. So get creative and have grit. I mentioned it in a couple of the buckets. You may have to partner up. So on conventional, for example, conventional is tough to get approved for in a lot of cases, depending, again, on the environment of the economic state that we're in. You may have to partner up with somebody who's got good credit or has a good job and give them a piece of the pie or whatever the case may be. But just get creative. Figure out a way. There's tons of people out there that have probably been in much more difficult situations than you've been in that have made this happen. So figure out a way to make it happen. Keep building the relationships over time. So again, if some of these guys and gals won't lend to you now, don't stop. Just stay in touch with them. Find out, keep updating them with your success, and follow through on what the lender tells you or asks you to do. So if you're talking to a commercial lender, for example, and again, they say, hey, go do a deal and then come back and we'll relook at things again in 6 months, then do that. Just go do a deal or follow up with them. Even if, let's say, you didn't get a deal, but something changed in your life, just keep following up with them. Still build that relationship. Keep building new relationships with new lenders while maintaining those existing relationships. So as you find out about new lenders, reach out to them, start building those relationships. And trust me, it's worth it. We have built a great portfolio, worth 7 figures over time. And it's all because of these banking relationships and these lending relationships. Without that, when I started, I didn't have hardly any money to my name, and it was all from these relationships and banking relationships and grit and getting creative and figuring out a way to make it happen. All right. And last but not least, guys, I'm going to teach you a quick little trick, a hack to get your money back. So if you are looking to do a BRRRR, okay, this is a really, really cool way to get your money back really, really quickly. So we talked about some of the lenders don't care if you have an LLC, some do. This is something you would have to do if you're looking to do a BRRRR, meaning you're going to buy, fix it up, rent it out, refinance it, and pull all your money back out. Okay, so what you need to do is, number one, you need to start an LLC. So you do need to do that if you want to do this to get your money back really, really quickly. Okay, and this is really a strategy if you're using your own home equity line of credit, or if you're using your own cash in the rehab or in the purchase. Okay, so you're going to start the LLC. Once you have the LLC EIN number set up, you go to your bank, you set up a bank account with your operating agreement, all that stuff. I usually just use an attorney to do this. It's really a couple $100 and they can get it done for you. You know it's done right. You bring those documents to the bank, you deposit funds in the LLC bank account. When it's time for the purchase, you're going to fund the purchase with the LLC's money, okay? And any rehab, if you want to get your rehab money back, if you're doing that, you're going to want to fund with checks from your LLC. So again, if you have cash in your own bank account, you're going to move the amount over that you want to put into this deal into your LLC. You're going to fund the purchase from your LLC or fund the rehab using checks from your LLC. Okay, this is really important if you're doing this strategy and you want to pull out your money quickly. And the reason why we're talking about this, if you are typically going to do what's called a cash out refinance, they require 6 months typically of seasoning. Some require 12 months of seasoning. And what that means is that they are not going to allow you to take your money back out for 6 to 12 months. If you just do a regular refinance and you pay off a lender, that you can do in a much, much shorter time frame. If you follow this strategy, you'll be able to get your own cash back and sort of avoid the cash out refinance designation. Okay, so we do need to make the purchase in your personal name, and you are going to have the title company record a mortgage and listing your LLC as the mortgage holder. Okay, so the mortgage holder, think of it like, let's say you went to Wells Fargo and you said, hey, give me a loan for this property. Wells Fargo is going to put a mortgage on that property so that if you go to sell it, you have to pay Wells Fargo off. Okay, the same is going to be true. Your LLC is going to be the mortgage holder. So that's why the check needs to come from the LLC for the purchase. If you're doing this for the purchase, if you're doing it just for rehab, you just got to put a mortgage on the property from your LLC if you're planning to do the rehab. And you want to do this at closing. Okay, you don't want to wait until you're going to try to refinance this thing, then try to put a mortgage on and do all this other stuff. Okay, so just do it right away when you close. And then let you do the improvements on the property. You get this thing ready to roll, and you're going to go, maybe let's say you're going to use that conventional lender and you're going to refinance that property. Okay, when you do that, what's going to happen is the bank is going to ask the mortgage holders, so in this case, your LLC recorded a mortgage here, they're going to ask the LLC for a loan payoff to remove that mortgage. Okay, and this is where you need to know your end financing goal, if it's conventional or commercial. How high will they go on that loan to value? So let's say your conventional lender says, hey, we'll go to 80% of the appraised value now. Okay, then we know, let's say we're all into it for 80,000, it appraises at 100. We know that we can pull out the entire 80,000 and pay ourselves back. Okay, so you're going to give the title company or the bank that you're refinancing through a payoff amount, and you'll want to make that whatever number you want, but up to that loan to value that the bank will go to. Okay, and if you have more questions on that, ask us and our team. I know this can be a little confusing if you're brand new, but essentially if the bank will go to 80%, all right, and you're all into it for 80,000, and it's appraised, the bank's appraisal comes back at 100, you're going to tell the bank that you have a loan payoff of $80,000 to your LLC. Okay, and then you're going to go to your LLC and you're going to get your check at closing, and you can deposit those funds back in your LLC account, pay yourself back, or if you took it out of a home equity line of credit, you're going to pay your home equity line of credit back, get yourself back to zero so you're not paying interest on that anymore, and then you can go recycle that and use it again and again and again. We've done this now a couple times, and we've done it within 45 days of closing. So it can be done really, really quickly. And that velocity of money, you can turn that money super fast and keep using it. So that's what we got here for the buckets of money, guys. Get after it, get these things in motion, and this is really going to give you a huge competitive advantage over a lot of people who are not doing this.